My next guest is an expert in this stuff. Please welcome America's accountant, Dan Geltrude, into the show. Thanks for coming on today, Dan. All right, I was sitting in the radio booth when I saw the ticker come across with that news, and it was a bad number. I mean, we did have some other things that weren't as bad. We had jobless claims that was okay, but I really kind of focused in on that because that was a bigger miss than the others were. Then they were good. And then if that's a good number, if that's a big miss, right? That means the economy's slowing, or it really would be something like that. Does the market take that as, we're slowing into the face of a bunch of interest rate hikes? Had it been really hot, would they have said, oh my gosh, we really have to start hiking interest rates? I mean, both of those numbers could have been deemed negative to the stock market, is what I'm trying to say.
Well, everything is interpretive, right, Scott? But here's how I look at this. When you see durable goods dropping that way, to me, that means that inflation is actually having an impact on people's spending, meaning running out of some of that easy money that's been around for the last year or two and saying, you know what? Maybe we're not going to make that extra spend on the bigger ticket item, because when you're talking about durable goods, those are things that generally cost more. And the price is going up and up and up, and people pulling back from making those purchases. I take that as a sign of an economy that's getting weaker. And then, of course, you look at what the Fed is doing and what their plans are in raising interest rates right now, which I think they've totally missed the boat here. I don't think it's a good sign, and I think that the market is going to be a little squeamish about what happens next.
Yeah, I agree with you, because it just seems that anything that comes across the tape nowadays, when it comes to being an economic indicator, if it's bad, that's really bad, because we're about to embark on all these 50-point basis interest rate hikes. But if it's a good number, that might be deemed as hot, and they definitely have to start hiking rates. And that also could be negative to the stock market. You know what I mean? Right now, it almost seems like any number that comes across the tape could be taken, if it's a bad one, as things are going to be really bad, stocks sell off. Or if it's a good one, things are really hot, they're going to really have to raise rates, stocks sell off. I'm trying to figure out what would come across the tape to make things better.
Maybe if everything stayed exactly the same. How about that? Where, any of these reports, like nothing changes, and kind of let everybody get a little bit of footing. The problem here, Scott, is that this market is so sensitive to headlines. I mean, come on. I mean, people were criticizing Donald Trump from coming up with policies related to what talking heads were talking about on TV. Is the market doing anything differently? Of course not. Somebody gets up there and makes some kind of statement and it hits the headlines, boom, the market reacts. What's it going to mean? I just think that in this information world that we're living in, we're probably overloaded with too much information. So how about this? A day without news, what would it do for the market?
Yeah, that's great. Or maybe if we could go back about 16 months and have that type of news too. And you know what we also say, Dan, you could probably attest to this more than I could, because you're in the minutia of the numbers. But I let everybody know that watches this show is that a lot of times the things that you're seeing trading, that's driven by computers. I mean, that's algorithmic trading, right? And so they have computers that can actually read the headlines, make a decision, and sell or buy on whatever they're reading. And if there's not a lot of humans involved, you'll see some pretty dramatic moves. And that's a lot of times what happens after we see some sort of headlines. The algorithmic traders take over, those boxes take over, the computers take over, and they shoot those markets up or down without really humans ever really getting involved, because the humans can't read the stuff that fast. So I want to make sure that everybody knows, especially the viewers of this show, that when we see the volatility like that, and we've done a few studies, we had one of our guest analysts say that he's done a study in the wheat market, because wheat was all over the place, just like a lot of the other things when it trades on the back of headlines. And they found out it was mostly algorithmic traders. Would you agree?
Yeah, I do. And the problem is with the algorithms, because one might think, well, listen, if it's math-based, that's a better thing. Not necessarily, because the algorithms are moving so quickly because of the human factor being out, and it's all technology, so everything can go that much faster. not necessarily a good thing, because the point you just raised was you could see these significant swings happening in a very short period of time. Why? Because you don't actually have, let's say, human logic that comes in. Not that we're always logical, Scott, but there can be a stopgap in there if you do have somebody saying, well, wait a minute, that's an overreaction. The algorithms, because they're mathematic based, are just moving according to what they're interpreting.
Right, and I'll add, I've been in some trading rooms before in New York and in London where some of these algorithmic boxes, these computer boxes, which have been all programmed to do these things, they're also programmed to listen to the CEO speak and detect any differences in the inflection of his voice. I mean, that is how high-tech things have gotten. So you have to remember that if you're going to be day trading or getting in this business, that's what you're going up against, number one. Number two is, buy and sell things you know and like, and don't try to be the first. You're never going to be that way with the computers that are involved. And know that when things do get nervous, like it is right now with Russia, Ukraine, a lot of that volume is going to be algorithmic.
I agree, Scott. The best advice that I think, can give to any investor out there is, one, don't try to time the market, right?
All right.
And number two, stick with what you know. Once you kind of go outside your lane, especially in the markets as unpredictable and volatile that they can be right now, again, there's choppy waters still ahead, and it's a big risk to take if you're going to try to time it and try to figure out what other people are thinking by going outside of your sweet spot.
I couldn't have said it better, and I'm glad you said it to these folks here, because everybody thinks they might be missing out on something, which I really don't think is the case. Like you said it, stay in your lane, do what you know, and just remember, sometimes when it gets really volatile, let the computers take over for a little while. Let them make all the mistakes for you, and then when things kind of get settled back down and that water gets warm, then dip your toe back in. I really appreciate you being on today. That was great stuff. Dan Geltrude, America's Accountant, thank you very much.